Hit it.
It's Friday, July 14th, 2023, episode 217. I'm Patrick Ceresna.
And I'm Kevin Muir. This week's guest is founder of Alpha Architect, Wes Gray. We have a fascinating discussion about his unusual career path, what it was like studying under Dr. Eugene Fama, and explore his fascinating new product, the BOX ETF. It was one of those interviews that time went by so quick, we wish we could have kept him for another hour. And then Patrick does his talking charts where he pulls crap out of his ass and talks about the market and pretends like he knows what he's doing.
This week we're skipping the no stupid questions and skin in the game. Don't worry, we'll be back to a normal format in the next episode. And folks, we might even drink some beers along the way, so stick around. We got a great show. Lena, hop on. What beer are we drinking this week?
So the guys are drinking Magners Pear Irish Cider. My God, I can't read. So just to tell you more about this beverage, we all need a bit of variety, and that's why we came up with the idea for Magners Pear. Of course, we like to do things properly and don't mind taking our time. So unlike some pear ciders, the only fruit that goes into ours is pears.
Okay.
What other fruit can go into a pear cider?
I don't know. It's pretty good.
I don't know.
Apples.
This is juice. Like we're supposed to have a beer, and I'm drinking juice.
I think
I'm not happy.
UK is rolling their eyes the fact that we're drinking. Let me do the side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include sell too early swirlies, the fat tail morning bail, and the quad witch stitches.
Yeah,
I like those.
That's nasty. All right, let's get to the guest.
It's our great pleasure to welcome to the show Wes Gray, founder of Alpha Architect. Wes, I've been looking forward to this for a long, long time. It's one of those times when I've listened to you on so many podcasts, I feel like I know you and we're kind of friends. And I realize that you haven't met us. And I really appreciate you spending some time with us so that our listeners get to know you as well.
Yes, I appreciate the opportunity.
And I knew you were a market huddle kind of guy when I said, how do I introduce you? And he said, Wesley Gray. He goes, oh, no, I'm Wes. And I don't know, just founder of Alpha Architect is good enough. You're laid back, casual. And I guess that speaks to a little bit of where you're from. Why don't you kind of tell us a little bit of how you got to this stage of your career? Like, did you always want to be in the markets? Like, what was it like growing up? Like, you have a fascinating story.
Yeah. So I actually, going way back, I actually grew up on a cattle ranch in the middle of nowhere in Colorado. And my introduction to the world was working out, digging irrigation ditches and chasing cows around and wondering how the hell I would stop having to do manual labor in my life. And so I asked my dad, hey man, if I don't want to do this for the rest of my life, what should I do? He's like, well, you should go figure out how to make money and not do ranching. I was like, Roger that. So I was just, it's not like a very sexy story, but I was, as a kid, financially motivated to not do what I was doing at the time. And then, I stumbled on to finance because I'd raised a 4-H steer. I don't know what 4-H is, but basically like, you
have to explain to us what's a 4-H?
Yeah. So 4-H is like a group where whenever, like if you live in like rural areas, you raise animals, you go to the fair, and then basically you sell them for way more than the market value because people buy them from the community. It's kind of like a community service. And you can raise steers, you can raise sheep, rabbits, all kinds of stuff. They also have competitions for plants and, best corn, best snow peas, whatever. But so what I did in 4-H predominantly, I raised pigs as well, but I raised a steer, which is just, it's a cow. If you don't know what a steer is, that it's a male cow that has his balls cut off. And they're the ones that you eat. And so I actually ended up making like $2 or $3 grand on this. And I don't even know, 10 or 12 years old. And my dad was a rancher. He didn't know anything about investing or money. But I have a grandmother who lived in San Diego. She's now passed, but she was obsessed with Warren Buffett and stock picking. He's like, talk to her. Right. And so I ended up talking to her, and then she got me all on the, Warren Buffett, Ben Graham thing. And then I was like, oh, wow. So this is how this works. You make money, and then you figure out how to make that money, make you money. And you don't have to have a real job. how do I do this? And so that was basically the early motivation to get into finance. It wasn't a real sexy idea. And then the problem was I went to undergrad at this place called Wharton, which is like basically a specialized business school.
Yeah,
and
I think you've heard of it.
with the researchers and all the professors. And I was like, I originally did this for money, and now I actually like this topic, right? Like I like trading, I like the markets, I like doing research, I like everything about it. Give me more of this. And then it became kind of more of a passion. And I was just lucky in a sense that like my passion of what I wanted to do just happened to also be a good way to make money. So it's kind of killing two birds with one stone. And
so
then,
you were doing that as an, sorry to interrupt, but you were doing this as an undergrad, and you got in with the professors and was already doing research and stuff as an undergrad?
Yes. So I started investing, trading. I mean, I'd been doing it before I was 18, but technically you really couldn't. But the minute I hit 18, I set up a Daytech account, which then got bought by Ameritrade, who then got bought by TD Ameritrade. I don't even remember. But yeah, I was investing like the minute I was adult legal, I was picking stocks, going crazy. This was during the internet bubble. And then I just, beyond that, I wanted to do like the intellectual side of it. And then so I literally just went into one of the professor's office, this guy named Professor Gatesy, and I just said, "Hey man, how do I be a research assistant?" And he looked at me kind of weird. He's like, "Well, you see all those books over there? Start reading them and come back in a few weeks." And that's kind of how it all started. And then the rest is history.
Wow. So you do that, you get that degree. Yep. And you go get you're a doctorate, like, so you actually have a PhD. Do you do that, or there's a little stint of, we're going to talk about something in between. How did the next stage of your life work?
Yeah. So out of spending my whole life trying to figure out how do I get away from manual labor and doing crappy work, I was like, oh, finance is the answer. And then of course, finish graduating. And then I get into the PhD program at University of Chicago, which is a hoity-toity finance PhD program. And I, right out of undergrad, which doesn't happen that often, got in, and then I'm grinding it out there for a couple of years. And I was like, you know what? I always wanted to do the service, and I was originally going to do it after high school. That didn't work out. Then I was going to do it after undergrad. That didn't work out. If I don't join the service now, I'm never going to do it, especially when I graduate with a PhD from this place. And then so I basically punted on all that and just went back to, grinding out manual labor type job again. And basically took a sabbatical and joined the Marines in 2004 and just did my 4 years there. And, we can talk about that. But then I came back and finished the PhD and graduated there in 2010.
Okay.
Finally.
So I do have I do have a ton of questions about the PhD because you studied under Eugene Fama, which is a famous professor, and we have many questions for that. But we have to talk a little bit about this because there's, I guess if you went onto a trading desk or a portfolio management group and ask how many people kind of quit their career halfway, or their education halfway through to go and serve in the Marines, it's going to be a pretty low list. What drove you to do that, and what was that experience like?
So, I mean, I would love to give you the easy answer and just say, oh, it was 9/11 or I was inspired, but it actually had nothing to do with that. For some reason, I was just, maybe by genetic decree or maybe growing up, in the mountains, I just love the idea of at some point in my life being in the service, and I'm like a big, go America guy. So, I'm all about freedom, all about the Constitution. And I just thought like, hey man, like, if you want to get, you gotta give, and I got to do this. So for me, it was just kind of like a calling to service. It was just a matter of timing. And that was just the best timing for me. And I wanted to try to get as much action in as I possibly could in 4 years. And for me, that was, going in the Marine Corps officer ranks. And so that's why I chose that particular path.
You served in Iraq, and you actually ended up writing a book. It's called Embedded, a Marine Corps Advisor Inside the Iraqi Army. One of the things I didn't realize is that, it says that you spoke Arabic. Is that correct? Have I got this right?
Yep.
So when did you just pick that up on the weekend?
Not exactly, but kind of. So I was an intelligence officer by trade, and one of the things about Arab culture is like the language is a much bigger deal because it's actually tied in also with the religion, Islam, right? Like unlike English, where it's like whatever, like if you can speak Arabic, especially in like Arab culture, and especially if those Arabs happen to be Muslims, it's like a huge deal, right? It gives you a lot of clout, gives you a lot more, I guess, respect, as opposed to just going in as kind of like the ugly American and being like, hey, we're going to go blow up more stuff and just do what I say and shut up. That doesn't work that well, especially in those cultures. And knowing the language to me was just like a mission essential. Like if we want to win this war, we got to obviously have guns. That's one method, but we also have to have influence. And it seemed obvious that the language was a key way to gain influence with them. And sure enough, I just put a lot of time in, and there was a lot of resources at the time because we had more money than God in the service because of GWAT funds. And so I just did everything I could to train beforehand as much as possible in the language. And then obviously when your boots on the deck, and in my job, we were embedded with Iraqi battalion, and I was the only one that was really into like learn the language and hanging out with the Iraqis. So I would just hang out with them every day doing everything. And it's probably like being a kid, right? If you get buried into an immersive environment and you get tired of doing hand signals to try to explain what you want, eventually you have to learn the language. And that's kind of what I did.
Well, that's just fascinating. And so you did that for 4 years. And you thought when you came out, I got to write a book. Was that your first book?
Well, yeah, it was my first book, and I never planned on writing books. But the issue there is before going into that, like everybody, you kind of learn with experience. I was very into like the Colin Powell, George Bush, like, hey, these guys are all going to kill us. Like the world's ending. They're going to kill us with their WMDs. And then, I finally came to the realization, like, wait a second, that's crazy. And then two, after living with these people for so long, our policy is totally whack. Like we're wasting so much money, time, resources, and people on a problem that's non-solvable. And you probably don't remember, but back then that was like a highly contentious statement. And so I literally had to write that book out of a passion because I had changed my mind on the issue so dramatically. And so I was like, I got to write this book because I know a lot of people think like me, and I need to share this experience of interacting with these folks and highlighting that if we keep this idea of like, let's make them a democracy and all this kind of thing, we're going to waste trillions upon trillions of dollars with zero benefit,
right.
which obviously after the fact that came true, so I got lucky on the prediction, but it's just, for me, it was more like a passion project to write that book because I had to tell the world.
Was there a lot of pushback when you wrote it? Like, was there a lot of?
Yeah, I did get a lot, actually. I got a lot of haters and people pissed off. They're like, well, what are you doing? And, obviously the tide changed pretty quickly there. So that was short lived. And then everyone's like, well, yeah, no shit, we should get out of Iraq and stop wasting money. But, there was a couple of years there where a lot of people, we're not buying what I was selling, basically.
It was practice for Twitter. It's like you get on Twitter and someone says something bad about you. You're like, what? Well, screw that. I wrote a book that was deeply unpopular.
Yeah, exactly. Well, and also the world's also changed in how much more contentious people are. So I think that wasn't even that long ago. That was like 15, 20 years ago or something. But, obviously everyone always argues and they're contentious, but there was still like some semblance of like conversation or, well, let's hear what you got to say and why. Whereas I think nowadays, if you were to write a book on anything that's like a contentious political issue like that was, I think it would have been way worse. So I kind of feel blessed that, looking back in retrospect, it wasn't that bad, because nowadays I would have probably been, I don't even know, hung out to dry or rotten tomatoes thrown at me or God knows what.
It's amazingly brave, to go do that. And then also to stick your neck out and to say, hey, no, I thought this and it's wrong. And this is why. It's really commendable. So let's talk about your return to the States. And you, as I mentioned, you ended up studying under very, very famous professor, probably one of the top ones in terms of portfolio management.
Yep.
And what was that like?
So it was a challenge reintegrating. And I basically had to relearn everything because I was in Chicago for the first 2 years where it's basically like hazing for 2 years, right? In the program back then, they used to kick out a lot of people, and it was just you study all day long, all the time, do math. I mean, it was crazy. And so I was well trained on that. But then I left for the service for 4 years where, I was trying to figure out how to kill people and not get killed. And so obviously when I came back, I needed to kind of update my mental capabilities. And so I spent about 6 months just relearning calculus and all the stuff that I used to know how to do. But the upside of the Marines is at the time, I was insanely like disciplined and regimented. I've gotten pretty soft now, back to normal, but I was just like crazy back then. I was like a machine. And so, when I wanted to do something is like, I'm getting this shit done. And so I immediately went to work on research, and then immediately went to Professor Fama and some others. And I ended up graduating the place, in total it was 4 years in the program with the 4-year sabbatical. And,
right.
And so, yeah, it was a quick learning curve to get up, but it was a great experience. Chicago was great for me because the culture of that place is like Milton Friedman. It's pure freedom. We're not going to tell you what to do or how to do it. You propose ideas, present them, and they just stand on their merits or they don't. And that's not great if you don't have a lot of, I guess, gusto or ideas about what you need guidance. It's not a great place. But if you're someone like I was at the time, that's like, hey, let's do this and let's rock. It was awesome. And so it was like a match made in heaven. And Professor Fama was also kind of a very no nonsense. Hey, I'm not going to tell you what to do. You're going to have to do the work and present it, and it's got to stand on its own merits. So him and I also got along pretty well.
So Professor Fama is famous for his portfolio theories, including the renowned Fama French 3-factor model, but he's also the efficient market hypothesis.
Yeah.
I'm wondering if kind of if you would go back and look at Wes Gray, under Fama during those years, what he thought about markets and how efficient they were, and then contrast that to the Wes Gray that's been in the markets and a couple of decades of real world experience under his belt. How has it changed?
So the good news is I've never changed, right? I started in 98, 99 trading during the internet bubble, and I was a value guy. So my initial intro to the markets is this is batshit nuts and insane. And there is no market efficiency. Whoever believes that pie in the sky idea is smoking crack. So I've always thought that. I still think that. I've softened my views more towards like, maybe it's a little bit more efficient than I once thought, but you will never catch me dead saying I think the markets are perfectly efficient. Everything's rational. So obviously, when I interacted with Professor Fama, and my dissertation was about studying a bunch of investment ideas from a whole bunch of stock pickers, hedge fund guys. In the end, he's super reasonable guy, especially in an academic context. It's like, hey, do the work, do the research, show me the data, subject it to criticism and outside thought, and it's either going to stand up on its own merits or it's not. And he's always like that, right? With any idea. Now, that said, the persona and the brand of Professor Fama is efficient markets. So if you're talking to Professor Fama in a research context, in like a one-on-one situation or academic deal, you can talk all ideas. The guy's hyper rational, hyper reasonable, no problems. If you're going to ask him a question at like a big Morningstar conference or a big podcast or something, he's got a brand to pitch, right? And
okay, I got it.
You got to kind of sell, because in those contexts,
you can't go off script.
Yes, you can't go off script, and you can't really provide enough context to highlight the nuance of it. So you just stick to the mantra of like, yep, markets are efficient. You guys are all going to lose your ass. Just go buy Vanguard funds. That's just his brand, and I get it. But I do, just for in his defense, he is actually an extremely reasonable person. And I know you or any trader or anyone who's in the markets active, if you had a conversation with them, you'd obviously, he would stress you and push you to the limit of your, obviously your mental capacity, because the guy's got more knowledge in one peaky than I got in my whole body. But he would be very open and willing to have the conversation for sure.
So from the book Embedded, you then went on to write 3 more: Quantitative Value, do your DIY or DIY Financial Advisor, and Quantitative Momentum.
Yep.
So why don't you walk us through your next stage of your career and how it unfolded?
Yeah. So it's basically a crazy story. So I'm graduating. So first off, going way back, I started a hedge fund. When I got back to PhD program, I immediately started to work on launching a hedge fund. Finally, and this is while I was working on my dissertation, I launched this thing in September 2008, which you probably remember was about the worst damn time to ever launch anything on planet Earth, to include a hedge fund. And anyways, long story short, that obviously didn't work out well, even though I actually had pretty good performance. It just didn't really matter because the world blew up. And so that was like my first foray into the business professionally. And then, 2010, I graduate and I go on the professor job market. Simultaneous to that, I literally got cold call by a billionaire who happened to read my blog and had read my dissertation, and he started propositioning me. So I ended up accepting a professor job. And then I immediately went up to New York City and met this guy and basically accepted this like longer term consulting relationship gig at the same time. Right. So, and so I start around 2010, I'm professing, but I'm also basically doing research for this huge family office. And my deal with them was I was like, listen, you guys want to hire me as a consultant, and I'm totally cool doing that, but I don't want to be a consultant. I would like to get into asset management someday, and I don't know any rich people, and you guys are billionaires. So if I do good work, like, could you seed me? Like maybe give me 25, 50 mil so I can get track record on real money and like build a business. And, long story short, after a few years of working with them, they basically said, yes, we'll do that. And so 2012, we got our first strategy seeded. And then, I finally gave up my professor gig in 2015 just because I had to focus on the business. But so that's how it all started. And then the books, how the books all started is, so Quantitative Value, which is that first book you mentioned there, which I wrote with Toby Carlisle, who's a good buddy of mine. That was just, it's kind of a passion project as well. I had always been obsessed with value investing. And I had all these like quantitative tools from, going to PhD program and everything. And so I just thought, hey, quantitative value investing, this is all I do. This is all I think about. And there's a lot, somebody needs to write a book about this story because it's only buried in academic research for the most part. And so that was a book that was about the story of how to marry quantitative tools with fundamental value investing. And that's also what we launched our first strategy on.
And was the first strategy roughly based upon the rules in the book?
Yes, is explicitly based on that. It's been augmented a little bit here and there over time for simplicity and some practical considerations. But for the most part, it's 100% what's, that core algorithm is what we've kind of stuck to. Now that's been terrible because if you know anything about factors like value investing, especially concentrated value investing, which is what we do, has gotten its face ripped off the past 10 years.
So wait, I'm sorry, I don't know what concentrated value investing, how that differs from regular value investing.
Yes. So value investing is generally like stock picking as an individual. And then there's like the quantitative version of it, right? So, and that's just using a computer to do what the fundamental stock pickers do, right? And so most people that run, let's call it quantitative investment portfolios, let's just say like a quantitative value investment portfolio, what they're going to do is they're going to say, hey, you got 500 stocks in S&P. What we're going to do is we're going to overweight the cheap ones, underweight the expensive ones, and call it a value fund. And it's basically going to be like the S&P 500 with some noise, right? That's like, that's normal. What we do is more akin to like what Ben Graham used to suggest. Now, we're not doing that. We don't care about career risk. We don't care about how we track the S&P. Let's just go buy the 10% cheapest PE stocks. I'm just giving you an oversimplified example.
Yeah, like how Julian Robertson with Tiger or something.
Yes, exactly.
Right.
You got it. So you just concentrate in in the value names. And,
Right.
what you take with that is the upside potential of what value is supposed to deliver over the long haul. But obviously the downside of that is you're very, very different and not like the market. So, depending on where the market gods go, I mean, you can look like an idiot for a long time, or you could look like a hero for a long time. It's just, it's basically like playing with fire. But that's all right. That's what.
All right. So you're doing this, you write that book, and eventually, you're managing the money for the billionaire. Is then Alpha Architect born out of that?
So yes. So we're doing that. We start that 2012, and we basically got $50 million seed in a 25 in a US version, 25 in an international version. And then we were very particular on taxes. And I had learned about the ETF structure. It's a long story, but I learned about like the tax mechanisms available, which it's basically a deferral vehicle. And immediately I was like, holy cow, if you're going to manage money in the future and it's taxable, you need to do it through an ETF or you're just wasting money. Right. And so we immediately pivoted to setting up an ETF company, and then we transitioned our SMA, our managed accounts, the 50 mil in the managed accounts, and we had a few other clients at that time as well, and we moved them into the ETF structures just because the ETF structure allows you to essentially not distribute capital gains anymore, which that's a big deal for taxable folks, and that was, I guess we launched our first the ETF version of the fund in 2014, so it took about a couple of years. And then that's what we've done ever since.
Can I just ask you a quick question about that,
Sure.
Hacks? Because so I'm a Canadian, and actually my background was that I worked at RBC, and I was the market maker for one of the original, basically at Spider equivalent. It was called the TIPS, and eventually it was the XIUs. And we always had to flow through like capital gains and dividends and stuff. So I'm kind of a little bit when you mentioned this thing about that you don't have to do this in the ETFs, is that particular to Americans, or do I not? Am I missing something?
So Canadian citizens can actually indirectly take advantage of the U.S. tax law if they own U.S. ETFs, U.S. traded ETFs, right? Not Canadian exchange traded ETFs.
Okay.
There is a downside. Obviously, you got to manage like estate tax problems, whatever, with the U.S. government. But so in Canada, let me step back. So the key mechanism that allows ETFs, especially equity-based ETFs, to not distribute capital gains in the States, at least, is the custom creation redemption process, right? So I can basically swap out Microsoft for Oracle for whatever in a tax-free manner. And we don't need to go into the weeds of it. That's totally kosher down here. And that's why Vanguard, iShares, and everyone who runs an ETF business, they rarely distribute capital gains in U.S. exchange-traded funds. Canada, I just happen to know a lot about this because we launched some Canadian funds with a group a couple of years ago. Canada also has, as you know, in-kind baskets and all this stuff. However, the ability to swap out custom baskets, like swap out Microsoft or Oracle, that you can't do that without tax consequence, right? So there's basically a tax difference in how they treat baskets in Canada versus the U.S. And so that's why U.S. funds doing the same strategy in Canada, the Canadian one would distribute capital gains very likely, whereas the U.S. version would not.
Right. And then once you say that, it makes complete sense that if you're sitting there and you're running a strategy, why wouldn't you just stick it in an ETF? Because you're, in essence, putting off all your taxes.
Yeah, exactly. I mean, there's a lot of hair on it because it's like, launch an ETF. We have a whole business that does that now. It's a huge pain in the ass, massive cost, massive compliance. But assuming you could abstract away from that and you just say, hey, where do I want to manage money that where it's going to be treated the best? It's going to be an ETF wrapper, all else equal. If you're dealing with taxable capital, there's obviously exceptions to the rule, and some strategies aren't going to work in there. But most equity strategies or tactical strategies, it's a no-brainer to launch them through an ETF wrapper if you're selling to taxable clientele.
Right. Okay, so let's talk about your newest product, because I heard you on Meb Faber's podcast, and the moment I heard it, I was like, oh my God, that's genius. And I had known about this trade for a long time, but I had never in a million years thought to myself, oh, someone should stick that in ETF. And so, first of all, kudos to you to coming up with sticking on this in this forum that allows regular folks to buy it. I'm talking about the box trade. Why don't you explain to people what it is and what your product does?
Yep. So as you mentioned, like box spreads or box trade, whatever you want to call it, they've been around since the age of time in option markets. But outside of market makers, 99% of the world, to include myself, who I have a PhD in finance, I never even heard of a box spread until about 8-9 years ago, because I just happen to have a bunch of buddies that are former Susquehanna guys, which is a huge like option market making firm in Philly. And they introduced me to this concept. And I was like, holy cow, that's awesome. And essentially what a box spread does is you use a pair of four, or you basically have a position of 4 options where you basically synthetically replicate a treasury bill, right? And it's kind of complicated, but the simple way to explain it, which I try to do on Meb's pod, is you essentially create like a synthetic long position by going long a call and short a put at a particular strike. And if you do long a call, short a put, you basically just replicated a long future stock position with options. And then the other part of the leg is a synthetic short position. So you may go long a put and short a call, generally at a different strike price, right? And as intuitively, even if you don't really care about options or box spreads, if you long something and you short something in the same trade, you obviously eliminate the market risk because you're long and short the same thing. So a box spread is essentially doing that. So you're eliminating the market risk. And what it's doing is it's isolating the embedded interest rates that are in option markets, right? And because those rates are obviously arbitrage, and you could always just go buy T-bills, they're generally in line with treasury bill rate. So if the 3-month treasury bill rate is 5%, well, the box spread rate is probably going to be around 5%. And so that's all it is.
So let's just actually slow it down a little bit and just talk about it in the real world, because I think you'll see these trades actually go up on the tape.
Yep.
And one of my big kind of complaints about people is that a lot of times we'll talk about all this gamma that's at 4,000, and I'll look at it and there'll be this huge open interest in this contract on the S&P, which is typically where most of this box trading happens. And it'll be like, oh, this open interest. I'll be like looking at it, and then I'll go look at the 5,000s, and it'll be almost the exact same position.
Yes.
So in essence, what they do is they go and they get long at 4,000, short at 5,000, and it ends up being $1,000. You get $1,000 today.
Yep.
And then for a certain cost, and so it'll be like a discount.
Yep.
And then on expiry of the options, you'll get your $1,000 back.
100%.
I got it right?
Yep. If you buy the box, if you do $1,000 spread, like you mentioned there, which is typically how we do them as well, just so they look more like a T-bill. It's more of a stylistic thing. There's also a lot more volume in those. You got it. You might pay $950, and you pay it post up $950 in 3 months, you're going to get delivered $1,000. Or you could go sell the box and you could borrow from the option markets. And so you're going to get $950, but you're going to owe $1,000 in 3 months, just as a hypothetical example. You got it. It's a way to borrow and lend through the option markets. And the rates are just generally better than prime brokers, right? Like if you go to Goldman and you say, hey, Goldman, I want to borrow money. They're like, great, Fed funds plus 50 bips. And if you want to borrow, and if you want to lend, sit your money in the cash account there, they're going to be like, oh, great, here's Fed funds minus 50 bips. And if it's Schwab, it's going to be like Fed funds minus 500 bips. And so why would you ever make the broker dealers and primes rich when you could just go direct to the lending market and the box spread market? Because now you're kind of going direct to consumer and you're cutting out the middleman. So it's a great.
One of the things you always have to ask is, where's the catch? And I think one people immediately might say, but wait, there's all sorts of risk. And actually, the counterparty that you're trading with has very limited risk. Can you explain that?
Yes. So like, as you know, treasury bills, the counterparty is obviously U.S. government. With options, everything is cleared through this organization called the OCC, the Option Clearing Corporation, which is a SIFMU. So it's obviously backed by the Fed. It's got the same rating from Standard & Poor's as the U.S. government. So yes, there is a different counterparty risk with the box spread. It's OCC, but from any third party perspective, it's basically the same as the U.S. government because, as you know, if OCC were to some reason go down, like the financial markets don't.
You got bigger problems.
It doesn't even matter. This is now like, where's your food and where's your guns? Because what's on your Schwab account doesn't count anymore if the OCC goes down. It's kind of an equivalent.
Right.
It's such an integrated financial institution. It'd be crazy. It'd be like the Fed going bankrupt, or I mean, it's just I can't even contemplate a situation where OCC would not be a good counterparty, or at least it's equivalent to the U.S. government in my eyes.
Right,
and that's not to say that.
So one of the things. Oh, sorry. One of the things that I was thinking about when I was trying to understand, like I always like to think to myself, okay, why does this exist? Why is there this arbitrage opportunity? And I get it. You were talking about how a hedge fund, if they want to go out and buy, like if they, instead of borrowing from Goldman, they can borrow from the market. And in essence, what you're doing as like someone that's selling the box is you're providing that liquidity at slightly below, you're undercutting Goldman. And one of my questions is, when you sell the box spread and you get that credit in your account that you've just borrowed money at let's just say T-bills plus 50, does that money have to be only used in transactions that are related to the options market?
Great question. So OCC, and this may be off a little bit because I haven't looked at it, but OCC only requires $100, or maybe it's $150 per 100,000 of notional box, i.e. there's no haircut for all intents and purposes.
Oh, okay.
And that's what they post up to the option broker dealers out there. So you could be getting screwed by your broker where you may sell a box and they're like, oh, great, you got 950, but you got to hold 900 of it back as collateral. But that just means you're totally getting like destroyed and your broker sucks. But most brokers, they maybe instead of charging you $150 per 100,000 notional, maybe they charge you $500, but it's still de minimis in the grand scheme of from a collateral requirement.
So if you're like a credit fund and you're borrowing to go along credit, you in essence could go and sell the box to fund it at a better rate than you're getting from your prime broker.
Yep, for sure. And you'd obviously, before you did it, you'd want to talk to your prime and make sure that whenever you throw the trade on, that they're going to clear it correctly and they're not going to like make you collateralize it, dollar for dollar, because that would kind of defeat the purpose. But most brokers I know, that it's the box has very, very little collateral requirement because OCC doesn't impose collateral requirements on them because, as we just discussed, there's no risk. It's a T-bill, right? So it's basically equivalent haircut on like a repo, effectively. And so it's not an issue.
Do you know, in terms of, obviously this trade's gotten more popular. I think you could just see it in terms of the number of, like, you just go look at those strikes and you could see them trading all the time.
Yeah.
Is that being driven more and more by non-option players understanding that this is a way to fund themselves?
I think it is. And honestly, that's our mission, is to empower the world on education to bring this market to bear. Like the big picture, what we're trying to solve here is we need to create a natural lending party. Like right now, there's tons of natural borrowers, right? Every market maker on the street is always in need of borrowing money because they can go, use it to make spreads and market make, but there's not a good natural lender. And that's because not many people on the lending side are even familiar with what the hell a box spread is. But as you know, like, think about how much cash is sitting in Schwab making nothing. Right. And Schwab is turning around and doing box spreads and making the spread or posting it up to Treasury. And so our job is to go tell the world, like, guys, stop making other people rich and just go direct to the box market. Because I know there's a huge supply out there that if they knew that there was credible mass on the lending side, they would look towards it a lot more as opposed to going to their big prime broker banks. And we're already seeing that because, box is already, like, I think it's 250 mil. And we have obviously massive interest in that thing. And more people are saying, oh, wow, like, you guys are starting, you've kind of herded the cats. And it's, so I think over time, there's going to be a lot more liquidity and a lot more, I guess, user friendliness with box spreads, where historically, unless you're like your background, like a, market maker, most people just get kind of nervous, entering a box trade. It's not like clicking the button to buy a stock. So obviously,
Yeah. No, listen, even for me, understanding it, like to be able to go execute it is tough. You need to aggregate large amounts. So the symbol is BOXX. And why don't you tell us what tenor you try to what are you targeting in terms of the tenor of that, how it works?
Yep. So
in terms of it should just chick tip higher like a T-bill, right?
Pretty much. So we target the 1 to 3 month duration range, and our cycle of duration is going to be a little bit different than like treasury cycle. Like when we may be at like 1 or 1.5, maybe an equivalent T-bill fund might be at 2.5, just because we're going off on the market, the option cycles. They're going off on the T-bill issuance cycles,
right?
But on average, it's always going to be duration like 1 to 3 months, and so that's what it is. It's basically trying to replicate a 1 to 3 month T-bill, except the box is set up where it doesn't have like a natural distribution per se. It's not like you buy a T-bill and you get a coupon, or I guess a T-bill you don't. You actually get it at par, and that's implicitly your interest. It's exact same thing with the box spread, right? You buy it at 950, you get 1,000, but within that ETF, and this is a whole nother conversation, but essentially what we're trying to do is not have any distributions if we can legally pull it off. And so the concept with box is it should just go up by the 1 to 3 month treasury bill rate forever. So you buy it, you come in, and it'll just kind of go up a penny or two a day, depending on whatever the interest rates are. And then if you sell it, you make the difference.
You pay your
and
taxes,
then you pay your taxes then. Yeah. Or you could wait and maybe pay your taxes later, but it's a flexible tool that, predominantly for taxable folks, it could be interesting.
Yeah, it's a great alternative in this day and age when lots of people are getting kind of screwed in terms of, as you mentioned, Schwab or whatever your broker is. You're sitting there with all this cash, and they're telling you, Fed funds minus 200 or whatever.
Yeah.
Even if you're lucky if you're getting that.
Yeah.
This is a way to get Fed funds plus.
Mm-hmm.
Let's talk a little bit about your other products. Like, why don't we go back to your original one, the first of your ETFs.
Mm-hmm.
And now it trades, and it's actually QVal. Was that the one?
Yep. QVal was our first fund, quickly followed by iVal, which is just, I mean, I don't know if your audience is familiar with factor investing, but it's put simply, it's kind of like Moneyball for stock picking, right? Like, hey, we think that instead of like, time on or percentage on base, and that seems to contribute to long-term winning, we think that buying low PE stocks contributes to long-term winning. In a nutshell, that's what factor investing is, right? Just using the characteristics of the stocks as a way to try to form portfolios to presumably like earn or shape your returns in the future. And we just happen to believe in value, which is basically buying cheap stuff that everybody hates, and then also momentum, which a lot of your audience probably knows. That's just, hey, buying stocks that have been winning. And so that's all QVal and iVal are doing, is they're just focused on buying cheap stocks that have some semblance of quality and doing it in a concentrated manner without really worrying about how it looks relative to S&P. And that's just all we do. It's very focused, brain dead algorithms that are trying to capture these kind of long-term return phenomenon, but we don't really sell it as like, hey, you're going to beat the market every day, every week, every year, even every 5 years. It's more of a, hey, if you have a 20, 30 year horizon and you want to follow like a disciplined process, deliver low cost, tax efficient, that's what we're doing. But you'll probably get fired along the way if you if you focus on this too hard, because it's just the nature of it. And that's kind of the arbitrage, right? Like very few people will ever be stupid enough to run portfolios like we do, because there's a very high probability you're going to lose your ass and your business. Why would you do that? Well, I just don't really care, and I wanted to build products for my own money, and I'm backed by like a large family office that also has 30-year horizon, and they don't really care what other people think. And so that's why we do it the way we do it. But that's also why very few people Like, even though our stuff is obviously open architecture and highly transparent, like nobody is ever going to like replicate or try to do what we do, because it's career suicide for all intents and purposes.
Well, there's a famous trader in the Market Wizards, can't remember which one he is. He says, I could tell you all the rules, and people still wouldn't be able to follow them because they're just too hard to follow.
Yeah, that's honestly, I've been doing this for 20, 25 years now. If someone pitches me on a strategy, if I don't know why it sucks to do, I know it's fake, right? All the good strategies, trend following, momentum, value, everything I've ever ran across, it's so easy and yet so hard. Like that, and that's why it works, right? It's like super easy, makes sense. It's got a lot of economic principles, behavioral principles, but no one's going to do it because it requires, too much discipline, too much relative performance pain. It's just the nature of.
Well, I think it's that latter that really hurts people.
Yes.
Like if you're sitting here and you're long these value names and you're watching your neighbors get rich on the Magnificent Seven.
Exactly.
It's tough. It's tough to do. And I just recently wrote a piece and I highlighted that even, Isaac Newton.
Yeah.
He bought the South Sea bubble. He bought it and made a little bit of money and then watched it go up without him and couldn't take it. And I also highlighted Stanley Druckenmiller was the same way.
Yeah.
Stanley, he talks about that error all the time.
Yes.
About how he watched the young people making all this money in 99. He couldn't take it and he bought it and he made the top.
Yeah. No.
One of the things you said recently is you said good old fashioned. Let's just talk a little bit about the markets, a little more kind of what I'd love to hear what you're thinking right now. You on Meb's podcast, you said good old fashioned sentiment hasn't been burned off yet. And that was probably a month ago. Mm-hmm. So it's kind of funny. So you have these unicorns, these 50 times sales companies that haven't made money, but you have Exxon who meant money all day long and will continue to do so, but won't have any valuation boost. The broad market is heavily invested in those go-go stocks that are way overvalued, but there are a whole bunch of firms that can actually make money. You can make a portfolio with 20% earnings yield. Meanwhile, the market is 5%. Can you explain to us like what you meant on that latter statement?
Yeah. So actually, funny enough, I just pulled up, let me just pull up the stats for you again. Unfortunately, that story basically hasn't changed, right? So I'm looking right now, the earnings yield on the S&P 500, right? If you just take like what are the earnings, like what's the price to earnings on every firm in the S&P 500, kind of holdings weight that, and there's different ways you can do this. Obviously, we do like earnings to price because the yield format, but it's less than 4%. So if you thought of like buying the S&P as like a business, like, hey, I'm going to buy this business, and assuming I distributed all the earnings and I didn't need those to reinvest in the business to keep it going, I'm only making a 4% return, right? That sucks for equity risk, right? Right now, international, it's like 7 or 8, which is much more reasonable. That said, if you go out and just literally buy cheap stocks in the US market, like let's just say, hey, I'm going to go buy the cheapest 10% PE stocks or something. You're going to start picking up all these Exxons and these kind of real businesses that everybody hates, but they make a lot of money. Right now in real time, you can form portfolios of those that have 20% earnings yield. So that has not changed really at all.
Right.
And I mean, a lot has to go right for a 4% earning yield business to outperform a firm you buy for 20% earnings yield. And as we know, every time you take bets where a lot has to go right and perfection has to prevail, it usually never does. And it's always better to buy with the margin of safety, buy the cash flow, buy the real business, and don't buy, these Ponzi schemes. But that doesn't mean in the short run, like your returns, because obviously like the stock price is not necessarily a reflection of like, the net present value of all the future cash flows, blah, 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 Fama's talk. It's just reflection of like all the yahoos collectively in the marketplace. And right now, all the yahoos are still, S&P, like I said, it's like a 4% earnings yield when you can buy a basket of US stocks for 20% earnings yield. And I wouldn't necessarily say they're lower quality. They're not sexy tech names or what have you.
Are you surprised at how quickly the correction, like for a little while in 2022, it looked like value might actually get a bid. Mm-hmm. The market might go back to, some semblance of normality.
Yeah.
And are you surprised how quickly it's bounced back to kind of almost 2021?
Not
No?
really. I mean, I was lucky. Well, I'm lucky and unlucky in many respects, but I started this in the internet bubble. And so I don't know if you probably remember this, but if you're sitting in your seat in like 95 and you're like, this is insane. Like, why are these things with a .com going up 100% of the day? You'd be like, this is stupid, short sell. And then 96, then 97, then 98. Now you've been bankrupted 4 or 5 times over now. And now you're like, this is the time that it's so crazy. Like, pets.com is 10,000 times revenue. Let's short this sucker. A lot of people tried, Julian Robertson, like all these guys. Guess what? You just went bankrupt again. So I am never, ever going to ever try to predict sentiment, because I've already learned the hard way that it's very finicky, and it can go a hell of a lot longer than anyone ever expects for no good reason tied to any fundamental anything. And so nothing surprises me anymore with respect to this kind of market action.
Fair enough.
Because it seems to be buried in the cake.
Do you think that all the advent or the popularization of kind of factor investing and computerized platform or portfolio trading has made it so that we've shifted around quicker, like in terms of you'll see kind of waves or kind of themes that go on for 3-6 months, and then maybe in the past that would have been a 2-year process?
That's possible. And a lot of people try to test that. I'll tell you one study I did, just because I was personally curious. And anytime I get personally curious, I was just like, all right, I'm just going to do the research myself, because then I know where the bodies are buried. So one of the things, like right after the pandemic, like I kept hearing this mantra, like, God, the stock market's so much more volatile because of like computers, technology, the ability to trade quicker, HFT, factors, whatever it is, whatever story du jour of the day people posted. That was the hypothesis. This market is crazier. And I said, you know what? This is something we can test. So I literally went back, and you can splice together from 3 different sources daily S&P or U.S. stock market returns going back to 1885, right? I went all the way back to 1885. I had to splice together like 3 different data sources from all these professors who like hand collect all this crap, because to get daily performance is a big pain in the ass, outside of computer age.
Yeah.
I put this huge database, daily returns on the S&P since 1885 all the way to the present. My first analysis was like, hey, I'm just going to do a basic histogram of daily returns on the first half of the sample, second half of the sample.
Okay.
You literally can't even tell the difference in the histograms. They're that similar. It's literally like a blueprint. And then I did all kinds of other analysis. There is literally anyone who makes that hypothesis or statement, which is reasonable, maybe it could be true because maybe things are about to change. But even now, empirically, if you look at enough deep data with like daily frequencies as best you're going to do, like going way back, the market is always insane and volatile. We just lived outside of like pandemic time. We lived through this period where like VIX was like it was just nothing was happening. It's just everything just goes up slowly over time. And I think people got muted to the reality that markets are batshit insane normally. We just hadn't seen that. And so, but that's why the beauty of doing long-term studies is you can kind of get to relive the whole history of mankind interacting in a gambling parlor called the stock market and quick identify this is no different even 100 years from now when they were doing this stuff with like, horse and buggy or whatever. So a lot of these stories, they're not empirically backed when you look at enough data and go back far enough. That doesn't mean I wouldn't be open to hearing counter arguments, because it's intuitively appealing what you're saying. I just haven't been able to prove it to myself.
Yeah.
And that's why I just did that brain dead study.
No, that's great. I'd like to hear that.
Yeah,
well, I can't remember what kind of market pundit said something to the effect of the markets are different today because they're always different. They're always changing. And but in terms of like, I guess when you're looking at the numbers, they don't appear that different. But like the actual stories that we're seeing, and we think, oh God, this is so different. But in reality, everything is kind of almost the same. It's just we've all forgotten about it because it was happened.
Well, and the other thing people forget is that everyone looks at the U.S. stock market. The U.S. stock market is arguably the biggest anomaly that ever existed on the planet Earth because it has the highest equity risk premium outside of, I don't remember who's number one, but they're like number two out of every other country in the world. But and that's just because obviously we've had like a great survivor run here, and obviously we have great freedom and all this other bullshit. But let's just be honest, a lot of it's probably luck. If you take an even broader perspective and say, hey, let's just consider equities more broadly across mankind, across every content, now you really see just how volatile and crazy stock markets could be. It's 3x the US experience, right? And so when you start looking collectively at equity markets in general, everything we're seeing now is like child's play. It's like, oh, what? We had a -10 today? Like, whatever. That's happened 1,000 times if you look across broad stock market. That's nothing. There's like World War II, all these wars, like their stock markets went down 70% in a day. 90. I mean, people just don't do enough history, and they get so focused on like their lived experience in their little data set called the US stock market. But I mean, I always just tell people like, hey man, if you're investing in stocks, buckle up, Buttercup, because they're so much riskier than what our lived experience has been thus far. And God bless us if that continues to happen. But you should probably consider that it's just in the data. It's not like this is a surprise or I'm scaring somebody. That's just lived experience over time of people who invest in stocks. It's crazy. And that's why you get paid a lot over the long haul to hold them, but you shouldn't expect to make 20% every year or, whatever, these people think they're going to do, especially buying an asset like the S&P 500 at 4 times earnings yield. Like when you could buy a freaking box spread for 5.5%, right? Like, yeah, it's just insane to me right now, what's going on. But like, I don't make these rules. I just observe them. It's all fascinating.
Wes, I could talk to you all day. We're going to have to get you on another time to talk about your other products and all your other insights that are numerous. I'm having so much fun, but we're probably at this stage where we should be asking you the final 5 questions. Let's start with your favorite investment book.
Well, I'm going to be boring. And I told you at the very beginning, like my grandmother made me read Buffett stuff. So my favorite book is Ben Graham, Intelligent Investor. It's just old school.
Can't go wrong with old school. Can't go wrong with that.
It kind of set me on my way, even though I do a lot of other stuff. That's still kind of my bedrock, I would say.
All right. Are great traders born or made?
I think like everything in life, it's a mix, nature, nurture. Some people are born with higher discipline, higher ability to withstand stress and chaos. But obviously, if you don't put in the time, learn the skills, do the work, who cares? So I think it's probably a mix, to be frank.
Okay. Don Cox used to say that you shouldn't invest on what's on page 1 today, but what's on page 16 on the way to page 1 tomorrow. Do you have any trades that you feel would get the Don Cox seal of approval?
Well, I don't know if he'd approve them, but last 10 years has been SPY till you die. SPY. I think SPY will make you die the next 10 years. And I think it behooves people to, diversify into like developed and emerging markets where you can get 2-3 times the earnings yield on the broad passive index. It's just, I think the next 10 years is going to be very different. So instead of SPY till we die, I think it's going to be SPY will make you die over the next 10 years.
I like it. That's a good, you should trademark that. Byron Wayne used to do his top surprises for next year. He defined a surprise as something the market had assigned a less than 1/3 chance of happening, but he thinks are better than 50-50. Do you have a Byron Wayne surprise for next year?
Well, actually, I think it's counter to what I just said. So I think in the short run, because momentum's pretty high and sentiment is still strong, I think you could have SPY to the sky. So I would not be surprised if 2023 is a 30-40% S&P 500 year, despite everything I've talked about on valuations and all this other stuff. So that would be my surprise. Not likely, but higher than most people think.
I like to remind everyone that in 1987, the S&P was up 40% going into October. Everyone forgets that. Nobody they all talk when they remember the big crash, but it actually still finished up on the year. So the point was there was an amazing run up that year. Yeah. Anyways, finally, what advice would you give a young person starting the business today?
Oh, man, that's hard. I mean, I just think it's the good old fashioned advice. Just find something you like to do and grind and work harder and add value, and you're never going to go wrong. Just good old fashioned rancher.
It's advice. Perfect. It's perfect advice for your your persona. Listen, before I get you to tell us about our Alpha Architect and sign off, I wanted to talk about something. I'm going to surprise you with this. On the Meb Faber podcast, you talked about iguanas, and I know you're friends with our good friend Harris Kupperman, who's also in Puerto Rico, and you talked about iguanas.
Yeah.
And you had a great little story about iguana at the pool. Why don't you tell people about what happened, and then I've got some follow-up trivia for you, and I'm hoping I can stump you.
Yeah. So I have many iguana stories at Cuppy.
Oh, you do?
yeah. He's down here as well. And so you get exposed to iguanas and they're crazy. But so that story, I think I remember which one it was. So I live on this huge resort down here, and we have this big ass pool, and this massive iguana jumped into this damn pool and freaked everyone out. But of course the kids go in there and start messing with them. And my kids had their little goggles on looking at this thing. And it was 5-6 minutes go by, and this iguana is just sitting there on the bottom of the pool. And I'm like, is that thing dead? And of course, I Google it to see how long these things hold their breath. And I couldn't believe it. I asked everyone there. I was like, it's the answer is 30 minutes, which is a lot. And
some
iguanas go for hours. And I asked every single person there. I was like, do you guys know how long iguanas can hold their breaths? And everyone said I don't know, 5 minutes, 2 minutes, 10 minutes. I'm like, no, 30 minutes. So that little dude is going to wait us all out. He ain't dead. He's just sitting there chilling. So okay. I think that was that story. It might've been a iguana story.
No. That was the story. So I actually then thought to myself, what other animals hold their breath for a long time? Mm-hmm. And so first of all, what do you think is the animal that can hold its breath for the longest?
Oh God. Non-amphibian, mammal reptile types?
Yeah. Yes.
I mean, I would have to think a whale or something, or a dolphin.
Whale's up there, but there's actually something else.
Huh. Fuck. I don't know, man. It's a
green sea turtle. The turtles can go some go 5 or 10 hours.
Wow.
Which is just crazy.
That's insane.
Now so this is the part though that's really, if you get this, I'll be really impressed because I had no clue. Okay. So the dolphin can hold its breath for about 10 minutes. Okay. But the land animal, which, iguana counts, that can hold its breath for the longest is 40 minutes. So your iguanas are actually right up there in terms of land animals. Okay.
Yeah.
But there's an animal that can hold its breath for 40 minutes.
Yep.
And it's a mammal.
Huh. Yeah. I was going to say, I know there's iguanas down in, off Ecuador, Galapagos, that can go for 2 hours or something crazy.
Oh, maybe I'm wrong about this.
Yeah.
You know what? You'll never get this because I had no clue, but the sloth.
Oh, really? Yeah. I mean, that makes sense. The sloth
can hold its breath for 40 minutes underwater.
Yeah. They don't need a lot of oxygen to get their ATP going. So they just sit there and die.
Their beats per minute's like an elephant.
Yeah. 5 beats an hour. I mean, that makes total sense given their activity level. They don't.
Yeah, and when I was Googling it, I found out the sloths only go to the bathroom once a week, and when they go, it's in the exact same spot.
Oh wow. Yeah, animal trivia is crazy, man. Have you ever heard about the eyes on this crazy shrimp that's got 15 cones in its eyes? It seems there's some shrimp out there. There's a great Radiolab podcast on eye cones and colors and rods and some dogs have 2, some animals have 5, and they found this damn shrimp that has 15. And I mean, it turns out their brain doesn't have the capacity to actually process all the information, but it's Yeah, and then also they can shoot their foot at like this faster than a 22 bullet. They're crazy. I think it's called a mantis shrimp. Like Google that sucker, and you'll be like, "What? That's the craziest animal I've ever seen in my life." Like Google mantis shrimp after this, or have your audience do that. They're fascinating little creatures.
So Wes, listen, this has been a lot of fun. Why don't you tell people where they can find you and your firm, and where they might look if they want more information on all these great products?
Yeah, I mean, main website, alphaarchitect.com. And then also we're big on Twitter. And my handle is Alpha Architect. So pretty easy. Twitter, and just hit our website, and we'll be happy to chat.
Thanks again, Wes. It was a pleasure meeting you, and it was a terrific conversation.
Appreciate it.
All right, Patrick, lots happening. Big week in the markets. What do you got planned for us?
Unbelievable, dude. What a week. I can't wait to talk these charts, but let's start with reviewing the other week, what we were watching. First of all, we were watching Bank of Canada. They increased rates. Obviously, Canadian dollar is doing very well. But the thing is, I don't think that's the Canadian dollar doing well as much as it is the U.S. dollar shitting the bed right across the board. So that really segues into number two. And the way that this moved, I actually almost think the U.S. dollar arguably should have been number one. Just what an incredible. It's a shock, but what a move in the dollar.
Oh, you're right.
Like
it has been the most important driver of asset returns probably this week.
Oh, unbelievable trend. We'll pull up the chart in a second, but number one was the inflation numbers. And obviously, year over year, we saw the real kind of momentum peak in the rise of the CPI index in June of last year. So as we got to this year over year number, of course, there was going to be some mean reversion, but really it looks like inflation in the U.S. is coming right in, and Powell is got a little smile on his, or at least a little bit of relief, knowing that at least that he can take claim to having been bringing inflation numbers in. What's your take?
Well, it was weak across the board. A soft number. It was soft on the core. It was soft on the headline. It was just soft. So the markets obviously have taken it and just run with it, assuming that we're probably near the end. I'm a little worried though. I feel like the market's gotten ahead of itself on inflation, and I suspect that might be the best number we see in a while. That's right. My prediction. I think that inflation is not gone by any means, and that, yes, of course, we had things like energy and some other base effects kicking in. But when you look back more forward, and based on the action that we've seen this week in terms of things taking off, I suspect that it's premature to claim the victory on inflation.
There you go. All right, so let's talk about the top three things to watch in the coming weeks. And really, it's interesting. Of course, I put the U.S. dollar, by the way.
I was joking with one of my subscribers. He just sent me a note based upon the action in the U.S. dollar. He says, "Boy, Patrick's going to have that as number one." So we're wrong.
Well, you know what we should do? We should only have the top two things, and the U.S. dollar should always be the third.
It's just a question.
And then
is it number 1, 2, or 3 according to Patrick?
But listen, it was interesting because next week is actually a relatively quiet week on the news front, and it is option expiration. It's not a crazy big expiration in July, but it is still going to be something that could gamma pin this market move a little bit after so much momentum. But really, we're going to watch whether that U.S. dollar, whether this is the beginning of a new breakdown, because to me, the momentum of this U.S. dollar breakdown was just technically far stronger than I was anticipating. Like, look at the drop in 5 days.
It was out of nowhere.
Like, I mean, the inflation numbers spurred it.
It was already weak in front of the inflation numbers.
Yeah. Do you think there's another catalyst that was behind it, or just?
I don't know. You know me. I'm such a long-term dollar bear that I just kind of. For me, it's
not
just
a
like
surprise
to waking up. But I
all,
continue, like everyone I know goes overseas, or I went to Japan, and we just sit there and we go, like, all these other currencies are so cheap on a purchasing power basis. And, you can talk all about milkshakes that you want, but the reality is that these other, kind of on a longer term basis, these other countries are cheap.
Okay, but this is the Market Huddle, and we're trying to talk trading, so let's not get too big picture here, buddy.
Okay, I guess part of the thing that some people might say is that it really started with the rumors about the BRICS, this crazy idea that they're going to make their own currency that's going to be gold backed. It probably, what was that on the weekend? I think that the first hints of that came Friday after the market closed. And if you look at it, I think every candle on that index, on that dollar index, is a big red candle.
Absolutely.
Right? So
it got hammered, blew, and it cut through its previous lows like a hot knife through butter, like just cut right through it. The point is, it's a top 3 thing to watch, because if this is not a turtle head formation and we have like a slingshot back to 102, 103 next week, if this is a sustained breakdown, I don't see technically how this just stops right here like a 99. I mean, this opens the floodgate. I mean, we could see 98, 97, even there's measured moves that are down to like 92 to 95.
Can I see that on the chart?
When you put it, yeah, sure.
Like magic and show me.
I would just leave it at this. Look at where the lows were from just 2 years ago. In 2001, I mean, the U.S. dollar didn't bottom until it was into the low 90s. And the thing is that with this breakdown, what's really stopping it to just randomly stop at 98 or 97 at this stage, unless this thing slingshots next week, or the FOMC or something turns it the week after? I think that this may have spurred the next major.
What would it take for you to say that?
You know what? But I would. Listen. I just want to know the major trend of the dollar because it influences asset prices. To be honest, I don't look at this just that this is devastating if the dollar goes down. I think that this would absolutely light a match under the entire commodity market. I mean, there is no better tailwind for rising commodity prices than a weakening dollar. And so if this breakdown's for legit, this could be what spurs very bullish commodity markets in the months to come. And this is why I think it's so important to see if this happens. I hate saying that there's a guarantee that this trend is broken and it's definitely going down, but this is ugly price action. And unless there's something miraculous that happens next week, and if this kind of price action continues, it's quite bearish for the dollar.
All right. Okay, what's number 2?
So number 2 is the earnings season coming up. Now, obviously, there's going to be some earnings next week that trickle in, but obviously the pig in the python moment really is actually going to be going into the FOMC, which is number 1. I'll get to that in a moment. But we have a situation where obviously this entire advance in the stock market has mostly been multiple expansion, and earnings have not played along. And the question is do earnings suddenly start to improve to validate that the market has read it right, or are we going to see that the earnings remain challenged in spite of the very bullish advances in the stock market? Do you have any insights on what you think?
Well, I don't know. I got into a discussion with someone about this the other day. If you go look at, depending on how you measure earnings, if you go look at like a blended 1 year forward kind of earnings estimates, they troughed in March or February, and they've been grinding higher since. So I'm not sure I agree with the analysis that earnings haven't played along, but you're correct that the PE multiple expansion meant a lot more than the slight uptick in earnings.
Yeah. And so it'll be really interesting to see whether Q2 earnings kind of keep the narrative going or not. And number 1, of course, is all the central bank statements. Obviously, everyone is talking about how the FOMC is and Powell are very likely to raise rates again here. It'll certainly be interesting to see whether they follow through on that. I think it was still around 90% based on the Fed watching the CME stuff. But we also have the other central banks, the ECB, Bank of Japan, all of them coming out in that second week from now, going into the 25th, 26th, 27th. And it'll be interesting to see whether these central banks move the markets or not. Is there something you're watching?
The Bank of Japan's one to watch.
Yeah.
Lots of increased chatter that they're going to move the YCC. This is a policy that's been in place for a long time. It was interesting to see how this new governor, stick handles this. So I think the Bank of Japan is the important one.
Yeah. Right now it's still 92% based on the Fed watching tool at the CME that the Fed raises interest rates here.
Oh yeah, they're going. The Fed's going to go. It's all, you're not playing for this play. What you're really playing for is the September meeting.
Yeah,
the Fed is gone, and they've told you that they went from 25 beeps a meeting. Actually, they went from 75 to 50, and then they went to 25. And this last time they went and they said they're going to do 25 every second meeting. Yeah. So in my mind, I've been thinking about it like they've been doing 12 and a half a meeting, and that has been the kind of where they are unless something changes. Right. So the real question now is, has something changed enough to knock them off what I call the 12 and a half beeps a meeting?
So you can see here right now, the forecast for the September meeting is showing 82% probability that they remain unchanged.
Right. They remain unchanged.
Yeah. Because the rate hike to this 550 basis point is happening this meeting in July.
Right.
So they're
that this month will be the last one.
Well, at least in September they won't raise, right? And so at this moment, at least that's what's being priced in. But let's talk some charts, bud. We gotta start with the currency markets. Like that, we talked about this dollar, but what is interesting to me, it really was the move in the euro, because obviously it's such a huge weighting in the dollar index, and the euro has just been a huge laggard. I mean, there was big moves in the yen, big moves in the pound sterling, the Canadian dollar was moving, everything was buzzing, and the euro was just kind of grinding it. I mean, advancing, but grinding. And suddenly in the last two trading sessions, it just really punched higher. Actually, I think we need to announce something, Kev. We didn't mention the fact that we're recording this after Thursday's close. So anyone that is listening to this over the weekend, we are doing this before seeing Friday's price action. But still, the last 2 days of the euro breakout was just a meaningful and full blast through previous highs, ripping. I thought even 112 could have been an overhead resistance based on fib levels and things like this, and it just ripping higher. But look at the way the pound sterling just had a huge update today. That US dollar yen, well, I mean, the big move was yesterday more than today, but all the way back to the 138 level. The US dollar against the CAD, basically after Bank of Canada announced the rate hike, edging right down, making a fresh, the US dollar is making a fresh low. It's just the market is buzzing. I mean, the currency markets are buzzing. The US dollar is in full retreat.
Yeah, I can't say I disagree. I will kind of opine a little bit about the euro. It really feels to me like most folks are extremely bearish Europe. And I just feel that that could surprise people because there's so much pessimism built into there.
Well, listen,
I saw a fellow from Barclays on TV the other day, and from the European side, and he was talking about China stimulus, and he was saying that if you're going to play for China stimulus, you should actually play, long Europe, because Europe is a beneficiary of China. I think our good buddy Marko Papic from Clock Tower has a similar kind of thought process. Interesting. All right. Well, let's touch on the stock markets and the S&P. You know what? No matter how much there's a bear deep inside of me just waiting for this to turn, the charts don't lie. This has been a relentless rise. Is that your Shakira impression? Do you even know what that?
Yes.
Okay.
The charts don't lie, buddy.
Okay.
But every, like, we're above all the moving averages, above all trend lines. All dips are being bought, higher highs, higher lows. There just isn't anything bearish about this chart. And now that we've kind of gotten all this additional tailwind and the dollar weakening, which really drives risk assets, it really asks the question: is there anything standing in the way from a full double top retest now of the S&P 500 from its previous highs?
Oh,
it's
you're saying the words.
What is that?
Well, you're kind of implying that we're going to keep going and stuff. It used to be, no, we're going to go down, blah, blah, blah. Now all of a sudden you're talking about it all the way up to the previous highs.
Look, it broke to a higher high. Midpoints like this is like an ascending triangle formation right here. Those midpoints become the midpoints of continuation patterns. There is, at this stage, if this breakout isn't a prairie dog, like, look, if come Monday next week, the market's back to 4,400, that could have just been one big prairie dog. But if this breakout sticks, it's got to go somewhere on the upside. And why would it stop anywhere? Like, why would it stop at 4,600 at this point? Like, at this stage, the only real targets on the upside are all its previous highs. And there isn't anything. Sorry,
I didn't mean to interrupt that. I was going to say, you know how I've been talking about the possibility of a 1987 kind of style repeat?
Okay.
I was doing some work to try to figure out like how much we're looking like that. So the S&P so far is up like it's 17% or 18%. This time in 1987, it was up 30 or 25%. So we're definitely lagging in terms of the S&P on the 1987 kind of analogy. But if you go look at the NASDAQ, and granted, the NASDAQ wasn't the same in 1987 than it is today. And it's a much bigger, broader kind of index and stuff like that. But I went and looked at currently the NASDAQ is up 44%, which seems insane, but from the start to the year, is that right? Does that seem about right?
Let me have a quick peek. Like off the low?
Yeah, no, off the since the start of the year, which is basically the low. Yeah, since the start of the year.
Yeah, since the start of the year.
That's right. It's up. I got it right. I got the number.
Yeah, 46%, dude.
Yeah. And guess what we were up in 87?
How much?
37.
Wow.
So we are outperforming 1987 right now.
That's insane.
In terms of the NASDAQ. And in terms of the S&P, we're behind.
Yeah.
And, I think people forget that they all think about 1987. They figure there was all this weakness ahead of it. It actually was up 40% on the year.
Yeah.
In terms of, and the NASDAQ was up 50% of the year. And then it ended up finishing the year up just because the first 10 months of the year were so strong.
Yeah. So anyway, the point though is like, look, you know me. I'm only thinking about where's going to be the next opportunity to get properly short. But you know what? Like, you just can't short this kind of strength. The only thing is to use strategies, and I will talk about it towards the end of the talking charts, because I'm applying a couple of these option strategies for this environment that really kind of hedge out downside risk while not getting dragged down during these face-ripping rallies. But right now, I hate to say it, I don't know what's going to stop this market. I mean, is it going to be okay? At minimum, I think this market can keep going until we get the FOMC and we get to the hump of the earnings. So at least another week they could keep ripping. The bigger question, I didn't bother to check yet what the gamma and the strikes are on all the option open interest in July. But I'm curious whether or not this kind of upside momentum actually puts dealers in a situation where they're being forced to chase with gamma on the upside.
No, there'll be long gamma up here.
Yeah?
Yeah, as you move higher. I'm pretty sure, I haven't looked, but I'd be shocked if up here at new highs for these moves that they're not long gamma. By the way, did you see what Jimmy Cramer said? He says to stick with the Magnificent Seven, which I love. One of my buddies termed it. He wrote Mag 7. That's his symbol for it. So stick with the Mag 7. And here's the quote. It's just so darn easy.
But you know what? It has been.
7.
It has been. It has been.
That's the sad thing is he's right.
All right. Anyway, let's talk some commodities. All right.
Okay.
Gold got the uptick. One of the things when we were talking charts last week, we were saying like it's been just stuck in the mud and it needs a breakout candle. It got a breakout candle. Now I'm watching. Like the most disappointing thing that could happen would be a reversal that gets this thing back below 19 and a quarter and testing 1900. But a breakout like this, particularly on a weak US dollar, really could be the start of a new move. So the question here is gold going to rip? What's particularly interesting about it is the breakout that you saw on silver, because if gold was bullish, silver has been blowing it out of the water. Look at this rip. It ripped through the June highs like they didn't even exist.
I don't want to comment. You know why?
Okay, yeah, don't say anything. Okay, so don't goocher it. Don't goocher it. So, but the point is that you have a fib retracement. This thing is ripping. We're going to see where silver wants to go. But like with this kind of 2-day breakout, it's hard to say that the gold isn't going to have similar style tailwind. Unless this was one big silver fake out, which I don't think it is. I think that we may be seeing the precious metals starting to move. The other thing I wanted to touch on is crude oil. And one of the big things for me was whether or not crude was going to be able to re-enter back into the trade range from the first quarter of the year. So there was obviously substantial bearish price action, but a lot of that bearish price action was on this idea that this recession is right here and now, and oil's being priced for lower demand. And suddenly, how can you reconcile the idea that there's no recession in a bull market, but oil has to price that in? And the point here, the fact that oil has gotten back into this trade range, at minimum, I would say it's neutralizing the downtrend, and the dollar breakdown is a tailwind. And so if we see a sequence where dips start being bought on crude oil during pullbacks, this could be the end of a 1-year oil bear market.
Oh, I'm liking this.
Right. And
you're making some calls.
Yeah, it's possible. Interesting. The other things, copper held a fib zone on this pullback and is breaking. It depends on how thick of a crayon you draw this line with, but is attempting to break out of its now 6-month consolidation. Will we see these kind of resources? I generally think the easiest way to think about it, Kev, is that a dollar weakness is a tailwind for all commodities. And even like this, using the Bloomberg commodity index, that's been basically in an awful bear decline all year, like for 12 plus months now, since the June highs of last year. And it stopped making a lower lows. Some would call that an inverted head and shoulders style bottoming formation developing, a potential breakout of the trend line. You take a look at something like just a broader basket of natural resource stocks, breaking out of trend lines. If the US dollar breakdown is for real and it becomes a tailwind for commodities, this could be the early stages of a pretty broad commodity bull advance.
All right.
No comment. Don't say anything.
I got no comment. I'm just going to sit here and enjoy the fact that you're calling stuff.
Okay, so
pointing out some great
10-year
lines.
Treasury bonds. I lost in 3 days. Unbelievable. I wanted to take that bet so bad, and who would have thought that this kind of a slingshot would happen? But
I did, of course.
Yeah. You did. Unbelievable move. But obviously,
goes to show you can still make money buying an overpriced option.
Well, yeah, as long as you got a
we did
CPI number
we'll talk
and
about
a
it
dollar.
properly in the
Next
when we
episode.
talk about it in 2 weeks' time or
Yeah,
whatever.
but
3
listen,
weeks' time. But
point is-
just so you know, I just want to tell everyone, I did price it out on the Bloomberg, and I did make it really cheap. And I thought he was going to bite, and he was too smart. He was smart to not bite because it was overpriced. But it was just one of those things where you shouldn't ever bet against your fundamental market beliefs.
But I'm not a super bond bull, dude.
Oh,
I'm just not remotely. No. The problem is the reason you pigeonhole me in that is simply because you are so bearish that me being not as bearish as you makes me by default somehow bullish. You're just way too bearish. I'm much more like, you know what? Interest rates have moved enough. I think things are going to chill for a bit.
Okay.
Anyway, is there anything else you wanted to look at?
In your apartment in Portugal, I'm going to take a picture of the Gary Schilling poster for everyone.
All right. Well, listen, Kev, before we wrap things up, I'm going to do a little shameless plug.
Okay, you go for it, bud.
Yeah, absolutely. At Big Picture Trading, we're going to be hosting a webinar. I'm going to be doing a webinar talking about some of my favorite option strategies to use in these kind of market conditions. And it's on July here. Let me pull it up here. Look at that handsome fellow in that picture. That it's going to be on July 25th at 1 p.m. You can register. Just go into Big Picture Trading /money. And I'm going to be talking about a couple of the strategies that I think are really amazing to use in these kind of market environments. And there's a couple ones like the back spreads, which I think are really ideal in this environment, particularly since we have such low volatility conditions, and they tend not to lose money when you're hedging the downside of the market when the market is doing face-ripping rallies. I'm going to explain that in the webinar why it's a great left tail hedge that doesn't grind and theta burn badly when the markets continue to bull. And I think it's a really valuable strategy in this kind of market environment.
So tell us the URL again, Patrick, and the date.
Yeah, it's July 25th. Just visit bigpicturetrading.com /money. We're going to include the link in the emails, and we're going to have it also on the YouTube page in the comment section below. All right. Anyway, Kev, I guess we just go to the close here, right?
That's right. Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give Lena a follow on Twitter at the Market Huddle. You can listen to Market Huddle on all the networks. Patrick, where can they find you?
You can find me at Twitter at Patrick Ceresna, or follow me at bigpicturetrading.com.
And
Kev?
For me, you can go, sorry to step all over you there, Patrick. And for me, you can go check out my newsletter site at themacrotourist.com, and you can go macrotourist.com /chat to come and chat with us. And listen, we can never have too many friends. Bear market, bull market. We're just happy to spend some time together on this crazy ride. Now stick around for the after show.
After show.
Okay.
How's the cider?
I like it. I guess it just makes me a full UK degen.
Probably does. You know what? I don't drink ciders that much, but I would need one that's a little more brute. This is very sweet for me, even for at least from the ciders that I've had. I've in the past had ones that just weren't as sweet. They were more dry, and I'm not a big fan of too sweet on the cider. I mean, it's interesting that they used pear. I like pear. It's a change up from using like apple. I'm gonna give it a 6.4.
Well, I'm gonna give it an 8.1.
Oh, wow.
Oh, my God.
I love everything Ireland. I might be a little biased.
Yeah, just a little bit.
There you go.
Nicest people in the world. Them and the Brazilians.
Seriously.
You're going to stick me on an island with a bunch of people. I want Brazilians and Irish there.
What about those Japanese people?
They're very
heard
nice, they're very kind, but they don't tell a joke as well. Or at least I don't understand it as well.
There you go.
Lena, how have you been? We haven't spoken to you in a while.
I know, it's been quite some time.
Yes. like tell everyone anything new and exciting, any new TV shows, anything you want to share?
No,
with the audience?
honestly, I haven't watched TV or movies in a while.
It's summer.
Yeah, it has been nice.
Yeah, so
It's
spending time outside or I'm working. So
nice.
Working. God, that Patrick, he's a real.
but there's also nothing to watch.
Well, are you going to go see any of the movies? We got a lot this weekend.
What's
Are you
coming
gonna-
out?
Oh,
I
yeah,
haven't paid
there's
attention
that
to
big
anything.
there's that big
Oppenheimer.
debate, but
Barbie double feature.
Oh,
They're
I'm sorry.
putting those two together, supposedly.
No.
Yeah, but-
They are. And the only reason I know this is because I got the AMC arbitrage on, like for the ape spread, and I get all the news. And so I see this stuff about like they're putting the two together for a double feature.
Well, what I was about to say is that there's a huge social media kind of debate out there as to which one do you go see first. And it's like, do you go for the one or the other? Which one's more important? Which one do you go see first? Because the consensus is everyone wants to see both. But which one do you go first? And
I'm sorry.
I have no desire to see the Barbie. It looks
Yeah, I have zero desire to see Barbie.
Yeah. Like maybe it'll be good. Maybe I'll be
Who are
eating
you
my
talking
word.
to that they want to go see a Barbie movie?
Yeah,
no, like, you know what? I'm talking about what's on social media. Like it generally, I guess that's the way they're trying to
when
make
those
bus.
women say they want to be your friend. You say no. Look at all these women that want to be my friends.
Oh my god.
I
Anyway,
don't get it. It looks
are
really
you
dumb,
gonna
and
are
I'm
you gonna
really
go
scared.
see?
Like Ryan Gosling usually does good movies, and I'm like, what the hell were you thinking, Ryan?
Listen, why don't you go see it first and then judge?
I shouldn't.
Why don't you go see it? Let us know
I
how
don't
it
do
is.
movies, Lena.
And then
but
we'll go see it based on your
I might actually
review.
go see Oppenheimer. I might. I haven't gone to the movie theaters in over a year. So like this might be a good enough reason to go this summer.
Do you know that the IMAX film weighs 600 pounds?
Where are you getting this information from?
Ian Bremner from he tweeted it out, and I was like, oh, that's cool. You see the pic? You see like the reel of it? It's huge.
Oh wow.
It's crazy.
Makes sense though. Makes sense.
Like it must cost a fortune to have all like the IMAX cameras and stuff. Like it must be a real endeavor to like shoot it in IMAX.
Yeah, but it makes a huge impact, right? Like
I don't know. Do you think do you go to the IMAX to
well,
watch
the problem is my my eyesight is going, so I can't really tell the movie is of high quality.
Hey, Grandpa.
Exactly.
I go to the IMAX. I sit in the second row.
If you're sitting second row, you're gonna break your neck.
No, they have it. Isn't it like some of them are the IMAXs are those kind of like balls where you kind of lie down.
Oh, I haven't been to an IMAX in a long time. I haven't been to a theater in a long time.
Yeah, I'm not a fan of the IMAX. I don't need it. I'll just go with the regular one. Thank you. They don't bring you drinks on the IMAX like the VIP in Toronto here.
Do you got any interesting summer plans, Kev? After
No,
Japan?
I don't actually. After my
First of all, how was your Japan trip?
it was awesome.
That's right. We talked about it last week.
They're lovely people, and they're it's a completely different world. They put up with my brutishness, and it was just fascinating to see. It was a once in a lifetime experience, and we really enjoyed ourselves.
Nice.
It was great. It was awesome. Actually, I really liked Tokyo. Like I loved it. I thought Tokyo was really cool.
Yeah.
And we went, where else did we go? We went up into Nagano. We did some mountain biking for my son. We went to Kyoto. We stayed at a ryokan, this really fancy ryokan where Charlie Chaplin got married. So I might have been sitting on the same shitter as Charlie Chaplin.
Wow, that's awesome. That's awesome.
And then we went to, speaking of Oppenheimer, we went to Hiroshima. We thought it was important to take the kids there, and for us as well. It was really moving. And then we finished up with some Okinawa beach time.
Very nice. Was there anything that you were like, oh, I expected this, but it was the opposite, or was there anything unexpected that happened, or that you've seen?
I think I was telling Patrick, they do not jaywalk ever.
Oh no, that's very frowned upon.
Like I couldn't believe it. We're sitting there like Like we had to hold ourselves back from like crossing roads illegally. They just know, like they follow the rules, and it makes everything more efficient.
Yeah, because rules only work when you follow them.
I guess so. I was just like,
we haven't figured that out in North America.
Like someone from Tokyo must come to like New York or Toronto, and they must be like, "Holy shit, what is this madness? Nobody's following any rules." Like in terms of like, you know, people crossing. And what's going on there? Whose dog is that?
That's Alina's dog, isn't it?
Oh, is he okay? She?
Sorry, she's alarmed by people walking by.
Oh, I am too. Anyways, it was a fantastic experience. They're very nice. They were so kind as we stumbled around trying to figure out things. And I must say that the Google Translate on your phone sure helped a lot. When you didn't know what you were doing, you just kind of pointed it out there and got the menu. And when we were really stuck and I had to make sure, I wanted to make sure I communicated properly, I'd like write out a sentence ahead of time and then like put it up to them.
I'll tell you, Google Translate and having mobile internet available readily everywhere is a life changer.
For sure, like especially for an international man of mystery like yourself, Patrick.
Yeah, there you go. But like honestly, it just being able to, you could have someone just talking to your phone and then it translate it. Like
I didn't know that.
Yeah. You could just hold the little microphone down. They talk, and it just.
I went 2 weeks without figuring that out. Oh
yeah, like
so,
literally.
Patrick, how often when you're in Portugal do you use like Google Translate?
Oh, everyone in Portugal speaks English. Like at least
they're really good there. So you don't.
No, you don't really need it, but yeah, like if you go to Central or Southern America, you need to have really good Spanish skills to get around, and so that's where you use it a lot. But like I'm gonna jump to like Italy for the weekend, and like you need, I don't. Anyway, there's you. It's very useful. Bottom line is
I had no idea that you could do the speaking.
Yeah.
And does it work? Because one time we put up like it was like toothpaste, and like we took the picture of it and it didn't quite work properly. And it was like shoot the moon toothpaste. It was like really weird stuff. It was a really strange translation that was just we were kind of laughing about.
Maybe it's just the right translation. They just do things funny.
Oh, the one thing I was telling Patrick last time was that the TV is just wild. Every single channel, not every, but most channels, they love game shows. And like we watched one and it was just fascinating. This girl was trying to stand on milk crates, like just put milk crates under her, see how many they could do. And then they have like 4 or 5 people on the side just with their reactions. And there's just lettering everywhere. It's like it assaults the senses. There's so much going on. I just loved it. I was like, I had no clue what was going on, and I was just sitting there mesmerized watching it.
Isn't it true that like so many game show ideas in North America originate from copycatting some of these
probably
shows out there?
I tell you, I turned on the TV like we got 20 channels, 17 of them were game shows.
Yeah, they love game shows over there.
Yeah, they love them. It's great. So it was a lot of fun, and the kids had a great time. It was great. We really enjoyed it. We got really lucky with the weather. We got no rain. It was hot as heck, but we managed. It was awesome. We subwayed around. We became like locals. I think we took like a Uber at the beginning and at the end, and that was it.
Awesome.
Yeah. So it was really
awesome.
It was really great. I was telling Patrick last time, Lena, that I was saying we should be embarrassed of our infrastructure as like North Americans, but Torontonians especially. Like when you see like proper infrastructure with subways and things that you just it's embarrassing that we can't make 4 lines or 6 lines.
There was like some sort of an article talking about how Japan, I don't know if it's entire Japan or if it's just Tokyo, they had used some sort of a fungus that always finds like the most efficient way around or whatever, and they kind of plugged in the data of the city landscape, and then they redid their subway system based on the fungus mapping or whatever. I don't know the proper terms for it, but I read it somewhere.
It sounds
so that they have the most efficient route for every line that they have.
I think we used
apparently.
I think we used raccoon tracks in Toronto.
No, that makes sense. That's awesome. All right.
All right.
Anyway.
Okay, everyone. Thanks for tuning in. We'll see you in 2 weeks. We're back to our regular schedule.
Yeah. Have a great weekend, everyone.
Take care.
Thanks.
Bye-bye.
Cheers.